Have you ever wondered what it would be like to be your own bank? I mean, really? Well, that's the radical idea we're diving into today, straight from the world of decentralized finance, or DeFi. We're going to break down exactly how DeFi lending works, how you can earn interest, how you can borrow money, all without ever talking to a single person in a suit.
Okay, so to really get this, let's compare the old way with the new way. Imagine you need a loan. In one world, you're filling out paperwork at a traditional bank. In the other, you're just interacting with a piece of code. And trust me, the difference is night and day. And this right here, this is the core of it all. A bank might take days, even weeks to get back to you. They pay you the saver, almost nothing, but they'll turn around and charge borrowers a huge rate. And that big gap in the middle, that's their profit. Now look at DeFi. It's instant. Anyone can use it. And the rates, they're just so much better for everyone involved. Why? Because you've completely cut out that expensive middleman. So let's look at the first side of this equation, being the lender. If you've got crypto that's just kind of sitting there in a wallet, not doing anything, DeFi lets you put it to work. You can actually start earning a pretty solid passive income on it. And the best part is how unbelievably simple it is. Seriously, step one, you just connect your digital wallet to the platform. Step two, you pick which crypto you want to lend and deposit it. And that's it. Step three is just watching the interest roll in. The moment your funds are in, you start earning. It's pretty amazing. So a great question is, where does your money actually go? It's not going to some company headquarters. It goes into something called a liquidity pool. You can just think of it like a giant shared digital pot of money. It's all managed by smart contract, which is just a fancy way of saying it's run by code that nobody can change. It's a transparent, automated vault where all the lender's funds are pooled together, ready for borrowers. All right, let's flip the coin. Now we're the borrower. And you might be asking, wait, if I already have crypto, why on earth would I need to borrow? And that's the key question. The answer is simple. You want cash for something in the real world, but you don't want to sell an asset that you think is going to be worth a lot more in the future. Now, this is absolutely crucial. In a world with no credit scores, no background checks, how does the system protect itself? It uses one powerful, unbreakable rule: over-collateralisation. It just means that to borrow, you have to lock up assets that are worth more than the loan you want to take out. This creates a safety buffer that protects the entire system. This chart makes it super clear. Let's say you want to borrow $100. To do that, the protocol might require you to first deposit, say, $150 worth of Ethereum. That extra $50, that's the safety cushion. It's the system's insurance policy that protects all the lenders in case the price of your Ethereum suddenly tanks. But what happens when that safety buffer starts to get a little thin? We all know crypto markets can be wild. A sudden crash can put that entire loan at risk, and that's when the protocol's automatic self-defense system kicks into gear. So here we're looking at a perfectly healthy loan. Someone deposited $10,000 worth of ETH to borrow $7,000. See that health factor? It's well above 1, which means they've got a nice, comfy safety buffer. Right now, everything is totally fine. And then it happens. The thing we all know can happen in crypto. The market takes a nosedive, and that collateral you put up, yeah, it's not worth what it was yesterday. And just like that, the collateral is now only worth $8,000, but the debt is still $7,000. That safety buffer has pretty much evaporated. The health factor is teetering on the edge, which puts this loan at huge risk of something called liquidation. Think of liquidation as DeFi's automated repo man. It's cold, it's merciless, but it is absolutely essential. The second your loan becomes too risky, the code opens the door for anyone, usually automated bots, to swoop in, pay back some of your debt, and in return, they get to take your collateral at a discount. It's a brutal process for sure, but it's what keeps the whole system solvent and guarantees the lenders always get paid back. Okay, so after hearing about this ruthless, automated process, I know what you're probably thinking. Why on earth would anyone take on this kind of risk? It sounds terrifying.
Well, it really just comes down to being smart with your capital. For instance, people borrow stablecoins to pay for a down payment on a house. That way, they get the cash they need, but they don't have to sell their crypto and get hit with a massive capital gains tax bill. Or, more advanced folks might use a loan to leverage up on an investment they really believe in. It's all about unlocking the value trapped in your assets.
So let's zoom out and tie this all together. After this whirlwind tour of DeFi banking, what is the one big idea we really need to walk away with?
This is the trade-off right here. You get to fire the slow, expensive banker, and in their place, you get fast, efficient, totally transparent code. But, and this is a big but, with all that power comes a huge new responsibility. You are in charge now. You are responsible for your funds, for your risk. There is no 1-800 number to call if you mess up.
And really, that's the question that this technology asks every single one of us. The tools to build a totally new financial world are here, right now. But using them means accepting a whole new level of personal accountability. So the question is, are you ready for that?